Please, speak as you might to a young child or a golden retriever.
It's an unfair game.
They're schemers. Schemers trying to control their little worlds.
The rich get richer, that's the law of the land.
It's just money.
Blasphemy! This is madness!
I drink your milkshake.
Hey everybody, welcome back to another episode of Milkshakes Markets Madness. Now, if you're new to the show and you're new to Brent Johnson, the man across from me on the screen, or you're completely new to what the heck a dollar milkshake is, we have plenty of information on our website, plenty of information on the YouTube channel. So we're not going to get into explanations here. We do welcome all the new viewers. We're starting to see the channel grow and we appreciate all the support. If you go to the YouTube channel homepage, there's different playlists that'll help take you down the rabbit hole of what the dollar milkshake is. But speaking of new viewers and just overall the enjoyment that you and I are having, Brent, with this show and what feels like success so far to us. I mean, we've just surpassed the 250,000 mark. And last week we had a huge episode, over 38,000 views.
Yeah, you know, it's funny. It was probably about 9 months ago, 10 months ago. I guess it was last fall when we kind of first brought this up. And, you know, when we launched the channel, the idea wasn't really necessarily to grow it. It was mostly just to have fun with what we were already doing. And, you know, a lot of different people had, you know, started shows and done these, you know, posted their comments, and we were already doing it anyway. So we just said, let's record it and see what happens. So it's been, I mean, to me, it's been fun, and I hope everybody else is enjoying it. And it seems like they are, and you know, we'll see where it goes from here. But definitely a big thank you to everybody that tunes in.
Yes, definitely a big thank you, and a few shout outs. You know, there have been plenty of people that have been with us from the beginning. They're always commenting, sharing, and showing some love and support. So here's a little bit of love back. Some shout outs to Coffee and Stocks, Vet Guy, Sage Knoll, Crestone, Colorado, iCrypto Mom, Jimmy Olsen Blues, Trevor Downey, Kim Eccleston, Paul Ditchell, Evan Z. Cap, Daniel Roland Anderson. And, you know, there's plenty more. There's a lot of handles out there that I can't even figure out. One, I think, says Gee Whiz Muppet. It kind of feels like that. But that person helped us figure out a new thumbnail concept for our clips of the week, which we have a fun one coming out. So we appreciate everybody and everyone new to the show. Thank you for joining us. Let's jump right in now with bankruptcy. Why not? We had YOLO, the shipping and transportation company, file for bankruptcy, but as a typical frenzy YOLO, no one cares anymore market, it went up 500% after the announcement.
Yeah, and it's just kind of par for the course, isn't it? I mean, after everything, it's funny. Whenever I start having these conversations and I say it's par for the course, and then I give a time frame, a lot of times I want to say year to date, but then, I mean, you could really say the last 3 years, and you could easily say the last 5, and then you could take it all the way back to the global financial crisis and say the last 15. But it seems the further we go along in this madness, it just gets more and more crazy, right? So, like this, when if you would have told me that 15, 20 years ago, like 2006, I'd have been like, what the hell are you talking about, right? This is crazy. And now I'm just like, yeah, whatever. Okay. You know, it's just like this stuff just keeps happening. And it, you know, to be honest, I haven't followed the story extremely closely, and I certainly don't know all the inner workings of why it's up 500% after declaring bankruptcy. But it's topical enough that I know that it happened, and it's just insane.
So that's one side of the barbell, let's say, of the craziness this week, or what was somewhat of the return of volatility. On the other side, we just had an absolute bond bloodbath. I mean, the yields on especially long duration just completely blew out. The 30-year bond was up 30 basis points. A number of yield curves were no longer inverted and steepened, particularly the 5-year and the 30-year bond. The 10-year curve, which you could have really compared it with any of the T-bills or shorter duration bonds, generally that was up. The curve had steepened over 20 basis points in just a few days, which was a 3 standard deviation event. When you look at these yield curves, it's been a huge discussion or topic point of recession's got to come. Look at the yield curve. It's inverted. There's a lag. It's been, 12, 18 months, whatever dates you want to pick since it's been inverted. One of the things that has been really, really quiet, we talked a little bit last week of how cheap insurance is, but the VIX has been pretty quiet. Now, charts and data suggest that lags the yield curve inversions by 30 months. So maybe we still have another year before things get really, really crazy. But what do you think the Fed is thinking in the situation where on one hand, we kind of patted Powell on his back a few times over the last couple episodes saying, hey man, he's at 5.25. No one thought he could do this. But at the same time, the NASDAQ and tech is just still off to the races. And now a bankrupt company is up 5x.
Well, it's funny because on the one hand, you could make the argument that they're saying, oh, holy cow, what do we do now, right? This isn't what we expected. But on the other hand, this is kind of what they wanted, right? I mean, you don't, and here, let me step back and explain what I mean by that. Is I think when Powell started this journey of raising rates, I think he was comfortable with the idea that he might have to cause a recession to do it, right? And while he didn't mind causing pain, he doesn't want the whole system to implode, right? And so as he kept raising rates and the yield curve inverted, I don't think he hated the idea that it was inverted, because I think he was trying to slow the market down, and whether it causes a recession or not, he wanted to kind of bring the pain to bring sense back to the markets, right? But the yield curve stayed low, or the long end stayed low. The front end kept rising. You got a steeper and steeper and steeper yield curve. But they all shifted up, right? So rates rose, but the yield curve stayed kind of steep, and bond prices fell, which I think he was okay with bond prices falling, because part of the way you slow the market, if you're a central banker, is you contract credit, right? Credit creates money. The more credit that's created, the more liquidity there is, the more there is a chance for growth. So if you want to contract the economy, you contract credit, it contracts the amount of money in the system. Well, what's the biggest underlying asset off of which the entire world economy is levered is Treasury bonds. So as Treasury bonds prices fell last year, that means that there was less capacity to loan because there wasn't as much collateral in the system. And I think he was fine with that too, because even though Treasury prices were falling, he wasn't having any trouble, or Yellen wasn't having any trouble selling bonds. Well, part of the reason is towards the end of the year, she bumped into the Treasury, the ceiling, right? She couldn't issue anymore. So for the last 6 months, she couldn't really issue. But up until November, every Treasury auction was being shown up at, and indirects, non-U.S. entities were the biggest buyers. And even year to date, as they maintained right up against the debt ceiling, they never had an issue selling Treasury bonds. And again, indirect bidders were the biggest bidders every time. And so now, while as we move forward and more of the U.S. budget goes towards just interest expense, it is kind of a problem. And I'm not going to sit here and pretend it's not an issue that we shouldn't pay attention to. But again, what I always come back to is there is not going to be a situation where the U.S. Treasury cannot fund itself, but the ECB and all the countries in Europe can fund themselves. There is not going to be a situation where the U.S. can't fund itself, but the Bank of Japan can, and the PBOC can. So while when I see things like this going on in the bond market, and when I see these arguments that this is bad, it's horrible for the U.S., yes, in an absolute sense it's bad, but you have to be careful not to get too hyperbolic about it being a death sentence for the U.S., when you have to remember it underlies the entire world economy.
Well, look, I kind of get a sense of where you're steering this, and I'm not ready to go there yet. I
almost did on accident.
I know. We're not headed towards this particular topic yet. I'm not even going to say it, but we're definitely going to tackle it in our conversation today, because I think
I caught myself right at the edge.
So we're pulling you back from the abyss. What the saying is, when you
right.
stare down at the abyss, and it stares back at you. So,
Yep.
but I still want to stay on this bond
Yep.
market sell-off topic for a little bit. And before I actually add another point to that, I want to highlight something you said, which is we are very, very sympathetic to the frustration of how broken markets really feel. And we started the show talking about the silliness of, bankrupt company being up 5x. You referenced, hey, in 2006, if you told me that, I would have called you crazy. So we certainly emphasize with the fact that this is not a, as you said, just in the midweek episode, these aren't free markets, right? But understand that if you were the one driving the ship, if you owned the biggest yacht in the ocean, you wouldn't just suddenly drive it into the wall. And so as much as these central planners, from the government down to the monetary authorities, are complete sociopaths, and we're on board with that, don't get too caught up in the fact that, that their track record isn't the best. Their goal is not to blow things up. So hold your horses on that. And I think that's a big part of, all kinds of different podcasts and YouTube channels. I think they get too caught up in that hyperbole where, look, we can appreciate where it's coming from, but understand these things take a long time to play out. Now, pause. We're not going to jump into the abyss on where that could potentially lead just yet, because one of the things that you brought up before, when we were first seeing a huge spike in yields a few months ago, we had a number of banks, fail, a number of others look to be insolvent. The Fed and the Treasury came out with the BTFP, the Bank Term Funding Program, so that banks who had all this collateral that was marked to market could be pledged to the Fed without taking a loss on it. It was a loan. There was other criteria involved in pledging that collateral, but they could get, 100 cents on the dollar of liquidity. So if there were deposit withdrawals and whatnot, they can meet those withdrawals. So what do you think now, revisiting that? It seemed like they plugged that hole temporarily. Now we've had this huge, sudden and somewhat vertical sell-off in the bond market. Are you suspecting that this could lead to further bank failures?
Well, yeah. I mean, I am convinced that the number of small banks in the United States is going to continue to fall. I know we've talked about it before. I can't remember if we ever shared the chart, but there's a chart out there, and I think it's over the last 20 years. And, let's say in 2000, there was, 14,000 community banks in the United States, and now there's like 4,000 or 5,000. So it's been a pretty steady drain on the small community banks. And I expect that not only to continue, but probably to accelerate. And you can kind of jump back to some past episodes of why that is. But that's one of the reasons why, as I've said, even though I've admitted that it hasn't played out, but why I've kind of stayed with my conviction that the second half of the year will be tougher than the first half of the year, because I think that stuff is going to start to show up again, not just in the United States, but I think in Europe and Japan as well. And the reason is, part of this problem is as bond prices have fallen, and then the banks have to sell them to meet customer withdrawals or whatever it is, they have to sell at these now lower prices. It's important to remember that the U.S. banks have a lot of low-yielding treasuries on their balance sheet. And as interest rates have risen, those treasury prices have fallen. What the U.S. banks do not have on their balance sheet is zero or negative yielding treasuries. And that's what Europe and Japan does. So if you think that buying low-yielding treasuries is an automatic guaranteed eventual disaster in the United States, then you have to use the same logic in Europe and Japan. And this is where we kind of get back to this relative markets thing. So yeah, and going back to the banks, if we have a tougher second half of the year than we had in the first half of the year, and we do get more, whether it's these community banks having a run on them, or they start to, go get into trouble, or if we just get general market volatility and people have to pull money for whatever reasons to fund their businesses or pay off their mortgage, whatever it is, and you start to get a less liquidity in the system than there is now, then that stuff can be exacerbated, I guess is the right way to say it.
Awesome. Well, you said the magic word that I want to talk about next, which is liquidity. This all kind of leads towards that. Last episode, you did make a point about you can have all these different things and indicators to look at. There's not one thing to focus on. We talked about the absurd market cap of some of these big tech companies like Apple. It was just $3 trillion at the start of this week. But you had emphasized what really matters is the ebbing and flowing of liquidity. For a little bit, at least it felt like the last 2 months, it seemed like, depending on what chart or expert you wanted to follow that focused on liquidity, it seemed like liquidity was ticking up. But you had also made a point, and this goes back to some of the episodes that we were doing around the end of the debt ceiling debacle. And once they raised that debt ceiling, you said that, you know, the government would immediately want to refill the TGA and issue a ton of bonds, and that would start to suck up liquidity and potentially, you know, put some downward pressure on, you know, a little bit of the FOMO that we're seeing in the markets.
Yeah, and so here's the interesting thing. It's funny how all of this stuff relates. It's really hard to stay on one topic without drawing in another because markets are so enmeshed with each other, whether it's a fixed income market, an equity market, and volatility market, and currency market. But the interesting thing for me was when the debt ceiling got raised, that was one of the things that I highlighted, that, you know, that new debt issuance was going to be, you know, they're going to be exchanging debt for dollars, right? So they're taking dollars out of the market. Now, if they immediately spend it back, there's not much effect. But if they use it to actually build up the TGA, which is the Treasury's checking account, then that's kind of a net drain on the market. But it didn't really have much of an effect over the last, or between, when was the debt ceiling raised? The second week of June, first or second week of June, I guess it was. And for the next 6 weeks, it didn't really have much effect. In fact, we saw a huge rally, in risk assets over that time period. But now, here, just over the last week, we've seen the Treasury come out and say, not only did we start, and they built up the TGA like 400 or 500 billion, maybe 600 billion pretty quickly over that 6 weeks. And now over the last week to 10 days, they came out and said, we're going to issue another $1 trillion in the next quarter or something like that, which is, think about that. They're going to issue another $1 trillion of debt in the next 3 or 4 months. Insane. Madness. Anyway, and then in the last week, and again, all this stuff kind of enmeshes with it. But yeah, I think it was a week ago we were talking about the FOMO. And I was telling you, I have FOMO, but I also have all of these indicators. If I had one indicator telling me to be careful, but I had FOMO, I probably would have just jumped in, you know, more directly. But I had all these signals, right? There was like 10 of them that were just staring me in the face. And so over the last week now, we've started to see, one of the things I said is that's when the last person jumps in. That's when you always get a correction, right? And that there's also fear of that. You have FOMO, but you also don't want to be the last guy to jump in and then just get hit up the side of the head with a 2x4. Well, you know, in the last couple of days, you know, this has been one of the worst weeks for equities of the year. Now this doesn't mean we're going to have an absolute crash next week, but, you know, things have started to kind of roll over a little bit. We'll see where it goes from here. But, you know, the Dow was down this week. The S&P was down this week. The Nikkei topped and started to sell off. The DAX, which is the German stock markets, topped and started to sell off. Apple, which is, you know, a bellwether, had a huge drawdown this week. NVIDIA, which is the best performing stock of the year, I think, or at least one of them, and certainly the driver of the AI boom, is kind, you know, it had an okay week, but it's kind of sitting right at the support level technically. So it's going to be and then, you know, in the last, not only that, but, you know, we're talking about the bloodbath and bonds this week, and there was, I think, the long bond was down like 4 or 5% at one point this week. Now today it was up 1.5% to 2%. So I think it finished the week down 3%. But, you know, this morning when the non-farm payrolls came out, it was kind of a Goldilocks number. You know, it was, anybody could find whatever they wanted to in it, but it was kind of a benign kind of Goldilocks number. And markets were up, you know, in the morning, markets were up anywhere from 0.5% to 1%. And then around 1 or 2 o'clock, things started to sell off, and it kind of became a crescendo by the end of the day. Now, again, you know, it's not necessarily Armageddon yet, but, the bond market turned around. I think the long bond ended up being up like I said, 1.5% today. Equities sold off. A lot of them broke their some technical levels on the weeklies. And so right at the time where liquidity, and we talked about this is the point where liquidity starts to disappear. So, and not only that, but it's, we talked about the lag effect of the interest rate hikes, right? The lag effect from the inversion of the yield curve. So again, we're starting to see all of this stuff come together right at the time where we said it would probably come together. Now, I think next week is going to be very interesting because this has happened many times this year where you get a little bit of a pullback and then they just rocket to new, everything rockets back to all-time highs. But we're kind of at this place again where it could very well bounce and go higher, but it could also, if it starts to break a little bit more from here, you start to get some technical damage, you get liquidity drying up, a bunch of hedge funds that had been short and were struggling, then got long, and now they get hit again. I mean, and we're going into the fall. That's the other thing. Like bad things always seem to happen in the fall, or at least when bad things happen, it always seems to be the fall. So, now we've got, a lot of people are away on vacation. The main people that run the desks are gone, and it's the junior people sitting at the desks. We've got an inflation number in the next couple of weeks, and then don't forget we got Jackson Hole at the end of the month. So, all of this stuff, the timing is it is very interesting.
I think I could see in the future us one day recording live from Jackson Hole. Can you imagine?
That would be great.
Milkshakes at Jackson Hole.
Let's just do it. Next year we go to Jackson Hole.
Sounds like a plan. So you were just discussing all these variables around liquidity. And for those who don't know, Brent Johnson is a avid waterman and lover of the ocean. And when I'm thinking about, what has been going on in the bond market, one of the things that happens when there's various predators in the ocean, if you ever experience attack by one of these, most people don't die from the attack. They ultimately end up dying from a slow bleed. And so maybe we've had this slight bounce back at the end of the week. Maybe that's a cauterization of the wound, but it feels like the bond market has kind of permanently, lost a limb here. It's really struggling to find its footing. I guess no pun intended in this case.
Yeah, and here's the thing with I should address this is I think a lot of times a lot of people tend to know my dollar views. And I think they kind of conflate that with bond views. I am really kind of indifferent to bonds, especially the long term. I have several friends who are super bond bulls, and I completely understand their argument, and I don't necessarily disagree with it, but I'm not playing it in my client portfolios. And here's the reason is because I'm just not sure. And the second reason is that part of the reason I am a dollar bull is I think in general rates were super low for 5,000, or they were 5,000-year lows, and I thought that they would have to rise. And counterintuitively, when interest rates in the United States rise, that makes the dollar stronger because people already have to own the dollar anyway to operate on the global stage. And if you get paid a higher interest rate to save your money in dollars, it just makes dollars even more turbocharged. So I don't need the 30-year bond to do well in order for my dollar thesis to play out. The other thing is that if I were to be playing the long end of the bond and you get it wrong, you get a week like this week, right? I mean, down 5% in a week. That's not really what you want your safe part of the portfolio to be, down 5% in a week. The other thing I'd say is a lot of people will say, well, why would you ever buy a 30-year bond anyway? You only get 4% a year for 30 years. Well, most people that buy bonds and most of these bond bulls that you see, they're not planning on buying bonds and holding on for 30 years. They're planning on buying bonds this year. They think interest rates will get cut next year, and they're not going to make 4%. They're going to make 40% if that happens, right? I mean, that's one thing to remember is you don't have to hold a bond for 40 years just because you buy it. But the reason I'm not in long bonds is, number one, I just don't know. I'm first to admit that I just don't know whether rates are going to rise or going to fall. I tend to think they're going to fall, but I don't know. And the other thing is that in my part of the bond portfolio, I keep them at 5 years or less, and I'm heavily into Treasury bills right now because you get 5%, over 5%, You get ultimate liquidity. There's nothing more liquid in the world than Treasury bills, other than potentially gold. And, you know, will I get as big a pop if interest rates fall, 250 basis points? No, but I can use if interest rates fall 250 basis points, something else is probably getting murdered and is probably completely beaten up. And then I can use my Treasury bill liquidity, which is paying me 5%, to go buy some really cheap stuff. So that's kind of why I am avoiding the long end. And, it's not a judgment call on what anybody else is doing, but it's just kind of the way I think about it. Yeah, exactly. Yeah, I've said many times I am not a fan of central bankers, and in many ways I think they are the group that is the smallest. They are the smallest group that's done the most amount of damage to the biggest group of anybody I can think of. I think I've told you this before. My friend Alex Gurevich said, "Have you ever heard of the Soviet Politburo?" When I said that, so I'm not a fan of central bankers, but I will say the one thing that if I had to pick one thing out that the Fed has done right, or that has put them in the position they are now, is they did not take interest rates negative, and they had all the opportunity in the world to do it, and they didn't do it. So I do give them credit for not going down that. That's a path to that's the path to hell right there, and you're going to see it in Europe and Japan. You can't escape from negative rates.
So what a great way to interlude into one of the biggest topics of the week, which was the U.S. credit rating getting downgraded. And it's so interesting based on what we were just discussing that would happen despite the fact that the central bank has been able to raise to 5.25. And we arguably are one of the only, maybe I guess you could say at one point, A+, AAA rated country that had real yields based on inflation. And we never did take things negative. And so why did the U.S. get a slap on the wrist here when yields are positive? The economy looks like it's growing, hence why the Fed keeps raising. I get there's all these lagging indicators, but the data we are seeing suggests that, the U.S. is kicking butt. Why did this happen? And do you think it was appropriate?
Well, this is one of those topics that you just... In the one sense, of course it's appropriate. I mean, the U.S. has lived beyond its means forever, right? They run budget deficits, they run trade deficits. The politicians are never in a million years going to spend less than the U.S. takes in, and this can't go on forever. So from that perspective, yeah, it's crazy. However, there's always a however, right? When you think of it again on the relative basis, there is no way that the U.S. goes into fiscal problems and defaults on their bonds and everybody loses their money, but yet Germany's doing fine and Japan is doing fine. It just, unfortunately, I understand that people don't like it when I say this, but I'm saying this because I actually want to get it through your head. Like, it just doesn't work that way, right? Now, it's possible that all sovereign bonds go up together and you have the U.S. default and Germany default and Japan default and PBOC. Okay, maybe that's the case. But when you understand that the system is designed with the dollar and the U.S. Treasury at the bottom, it's like saying that you're going to blow up the foundation of a house and yet the attic is going to be perfectly fine and the second floor is going to be fine and the swimming pool is going to be fine, not going to have any cracks in it. It just, you can't remove the foundation of a house and have the rest of it stand sturdy. It will not happen like that. So from that perspective, I can understand on an absolute basis why they would put out a report that says that. And perhaps it's a way for them to gain quote unquote credibility, right? We're the one firm out there that is saying this cannot continue. But on the other hand, it is also a little bit like a stunt. And maybe not an incorrect stunt, but it is a little bit of a stunt. Well, what I find interesting is that this same thing happened about 11 or 12 years ago, 13 years ago, whatever, 2011. Standard & Poor's downgraded the United States. And this happened when all of the problems in Europe were going on. You know, they were calling them the pigs. You know, Portugal, Italy, Greece, Spain, you know, we're all having problems. And in the midst of this, Standard & Poor's comes out and downgrades the United States. And remember, I don't know if you remember this, what happened was when that happened, Treasury bonds rallied. So even though they got downgraded, Treasury bonds rallied and stocks sold off. And a month later, the president of S&P got fired. Or I think he resigned to go spend time with his family, or however they put it. So I'm not sure what Fitch was trying to accomplish with doing this. Not only that, but here's something else. I just thought of this. It was about 6 or 7 years ago where, do you know Pippa Malmgren?
Yep.
So Pippa was on a panel at the Michael Milken Conference in Los Angeles, which is a big conference that, you know, they get amazing speakers. So it was Pippa, it was the guy that runs strategy at Jefferies, it was a central banker, I think from Europe, it was a big bond guy from PIMCO, and it was the head of sovereign ratings for Fitch were on this panel. And David Zervos is the guy from Jefferies. So I think David Zervos said to the guy, to the head of Fitch sovereign rating, said, what would you do if the Bank of Japan were to forgive all the debt that they own of the government? If they were just to forgive the debt, write it off. And he said, the head of sovereign ratings for Fitch said they would probably upgrade Japan because now they didn't have any more debt. Right? So on the one hand, you've got, you know, the same firm saying they would upgrade Japan if they just forgave the debt. But at the same time, the Fitch is downgrading the U.S. and because of all the debt. So, you know, I get why it's a big deal. I understand why it's a big headline. I understand why everybody wants to gravitate onto it and say, oh, see, this is what we've been talking about all along. But on the one hand, I honestly don't think the downgrade means much of anything. I just really don't. I understand why they did it, but I just don't think it means that much for markets.
All right, look, so we've covered the full gamut here. We started out talking about company going bankrupt, markets YOLOing 500%. We're now talking about this downgrade. We, in between, discussed the bond market, the government debt situation, why even though, you know, fiscally it has its issues, it's still potentially considered the cleanest dirty shirt. Everyone's got their problems, but let's talk about the Fed one last time before we wrap up here. You now have a situation where, like you're saying, the government, when was the last time they generated more revenue or income than what they were spending? So we've been on this awful track record for a really long time. There's only so many ways you can get out of debt. And it doesn't seem like massive GDP growth is going to be the solution here. So typically sovereigns inflate their way out of it. In this current situation, it feels like the Fed to some extent has their back against the wall. A lot of things are going to, unfold even just in the next 6 months, let alone the next, let's say, 6 years. No one has a crystal ball even close to that. But do you think that there's a potential, although you've been giving the Fed credit for not going negative, that at some point the either directly from QE and yield curve control from the Fed, or just because the market panics and starts gobbling up U.S. bonds, do you see interest rates going negative ever in the U.S.?
So I could see Treasury bills going negative. That would not shock me. And that would be some kind of a disaster scenario, but I could potentially see that happen. I do not think that the Fed will ever set them negative. And I've said that for a very long time. I don't think that they will. I don't put anything past them, but I don't think that will happen.
Well, Brent, lots of valuable insights from you this week. We appreciate you jumping in. And again, thanks to everybody who's been with us on this journey. It's been fun, and we're looking forward to doing it much, much longer, at least until Jackson Hole next year. But if you're new to the show, please visit our website at milkshakespod.com. Even better, visit us on YouTube at milkshakespod. We have a lot of easy to follow playlists there. We have a Start Here playlist at the top where you can kind of go down that rabbit hole. We have all our full episodes. We do a Monday peek at the week. We do a midweek update. Everything is organized there for you. It's pretty visually easy to identify what episodes are what. So I think for anyone who's new and wants to learn a little bit more, and anyone who's been with us and wants to binge, it's laid out there pretty good for you. Now, if you want to chase down Brent on Twitter and chat with him there and send him some questions or comments or your own thoughts on what markets are going to do, you can find him at Santiago AU Fund. You can find me at John Kutsmita. And I think that will do it for us this week. Brent, any last words?
No, it's been a good week. It's been fun. So, I actually like it when there's volatility in the market. And maybe, here's the funny thing. Vol is at 17, and I'm like, that's high vol all of a sudden. Typically that's low, but because it's been so extra low, now we're back at 17, and it feels like we got some volatility. So, we'll see how it goes. Hope everybody has a great weekend. Thanks for tuning in, and talk to you next week.
See you, everybody. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.